Good morning, ladies and gentlemen. Well, no point in looking at the risk dial. This is the big one, FOMC, and before that, the last data point is retail sales. Now, retail sales is the last data point, as I said, that Waller mentioned, and it's hard to believe that retail sales is actually not going to be a strong number because earnings are very good indeed and they are above inflation. So let's examine what is going to happen if the Fed does a normal dovish rate cut, i.e. it's not a hawkish cut. What would he say? He would say that they are still restrictive and the risks on inflation and employment are balanced. And basically he'd just leave it at that. And that to me is a normal dovish cut. The SEPs might change by one, and I've put the SEPs down here for you, but I will upload this file so you have it all. One less cut in 2025 and probably an unchanged 2.9 longer term, which you find here. To me, this is very unlikely, simply because it's so hard to balance the different opinions on the committee. And inflation has proven sticky and stubborn. And even Waller acknowledged that. And therefore, I find it very difficult that he's going to be able to carry the whole committee and not have dissenters. So I think that that is the least likely outcome, but if it does happen, the big risk is that he loses the long end, because to me, in my humble opinion, if he just says that, he just does not care about getting inflation back to 2%, and he will tolerate 2.5%. And if you tolerate 2.5, you'll tolerate 2.8. And if you tolerate 2.8, you might even tolerate 3.1. And that is just not acceptable for the longer end of the yield curve. Just do steepeners and walk away. That's all I can say. The yield curve should steepen quite a lot. And we'll look at that later on, of course. Now, what is a hawkish cut? A hawkish cut is where he says that they wanted to normalize the balance of risk between inflation and employment because we did have some slightly worrying numbers during the summer. And yes, they normalized those risks and that's it. And from now on, they're going to be absolutely data dependent. And if the data does not show that that the inflation is falling, then they're open to all outcomes. And why not? I mean, that is surely the job of the Fed, to be open to all outcomes. They might have their preferred path, they might have their preferred idea of where the data should head and why. But if that just does not happen, then they should be open to the fact that their models are wrong. And they've been wrong before and they'll be wrong again. So to me, this is the most likely outcome. What happens? You buy the US dollar because you have seen how many cuts there have been in Europe, in Switzerland, and also in Canada. They've all done 50 basis points. The ECB has done 25, but it was a normal cut. There was no hawkishness attached to it, which means that they go again in January. So the hawkish cut is the one that is most likely, in my humble opinion. But if they really want to be hawkish, let's face it, they do no cut. And they explain it via the data on inflation, which has been stubborn. And that's that. You raise the SEPs back to where they were in June, okay? And these are the June projections, or very close to where they were in June, at least close to them. And you say, okay, we don't know what the future's going to bring in terms of the new administration, i.e. tariffs and fiscal policy. It might be inflationary, it might not, we don't know. And we want to retain optionality and future flexibility. Therefore, we're not cutting. I know that that is not likely because they absolutely hate to disappoint the market, and the market is pricing in a 96% probability of a cut. But that is what I would do, but that's neither here nor there. So in terms of likelihood, this is to me the least likely, second least likely, most likely. Last week should have been a shock for the Fed because what happened in the bond market was not normal. I know that all we have done is basically retraced some of the way or all of the way, depending where you look on the yield curve or what happened in the past 2 weeks. But ahead of an FOMC meeting, this was slightly worrying behavior. Yes, the twos are the least affected. Yes, because they know that the Fed is dovish and they know that the Fed is going to cut if the probabilities of a cut are high enough. Simply because, as I said already, they hate to disappoint the market. But don't look at the twos, look at the tens and look at the 30s. One could argue that all they've done is basically fill this gap. And this gap was created when the announcement of the new Treasury Secretary was made, and therefore everybody said, great, good chap, he will do something about the deficit. Well, it doesn't look like the market held that opinion for very long, does it? So the steepening that happened last week is really quite worrying. We are back to where we were at the lows, and the market is now waiting. If we get the normal cut scenario, I think the curve steepens a lot. I think we go down to here. I think we go down to 42, minus 42, and that's all there is to say about it, and that's all there is to think about it. That will be the move. And in 2/30s, you are probably looking down here at around the 80 level. The big danger, I have to stress, is that they lose the long end. That to me is the big danger. So be very careful at the long end. If it's a normal cut, I think the steepening of the curve is going to be very dramatic. To me, once again, and I have to repeat this, to me the argument is going to be these guys don't care whether it's 2.5, 3, 3.5, they just don't care. When that happens, you just start losing the long end, and all you can do is follow the massive fundamental flows which will develop, and those will be buy real rates, right? Buy tips, buy gold, buy equities, those, and abandon nominal bonds. Those will be the flows from the big players, and I don't think there's going to be anyone who's going to stand in their way. One of the big signals of the week was 3 months, 10-year finally disinverting after a very long time. And where are we going to go? Well, I guess we're going to minus 31. What does that tell me? That tells me that the Fed cuts and it loses the long end, because the short end isn't going to go anywhere. 3 month, if they cut, is going to be, more or less stable where it is, unless they expect huge cuts to come. And I don't think so. I think the 3 month can only go down another 10 basis points or so, basically to meet the 1 month. That's a differential of about 7 basis points. So the difference must come from the 10-year going up, right? So this chart is basically saying that we're going to have a bit of a dovish cut. Will it happen? I don't know, but certainly to me the fact that this is happening sort of increases the odds of a dovish cut. Personally, I would love to see a hawkish cut, but I look at the charts and I know which way I'm going to jump, whatever the outcome is. So again, if it's a normal dovish cut, the big risk is that the yield curve steepens out of sight. and also that term premia start going out strongly. Another type of steepener you should consider if the Fed is dovish is the 10s 30s. The 10s 30s tends to be pure, how shall I put it, term premia. 10s 30s, as you can see, has been very, very stable throughout 2024. This is where we started in. Let's have a look right here, and we are what, 5-6 basis points away. So the volatility of the 10s 30s is not large, but when it gets going, when term premia expands, 10s 30s could be a very, very big mover. And as you can see, this is the longer term, it could easily come down to here. And the reason why I would pick 10s 30s is that I think precisely that term premia would expand if the market decides that they are not being responsible and that they really don't care what the level of inflation is. If that is the case, you really want to have 10s 30s on as well. And the beauty of 10s 30s is because the volatility is so low, and 10s 30s never go negative and stay negative, is that you can do a lot of them, right? You can really ramp up your position, and it's a much safer position than 2s 30s, 2s 10s, because to me it makes perfect sense that term premia will get expanded on a Fed that is being, or the market judges to be, irresponsible. So you can do a hell of a lot of it. And each basis point is a basis point, right? Whether you do it in 2s 30s or 10s 30s. And therefore you can do that much more here because the volatility is very, very small. You're only risking 4 or 5 basis points to make, 20, 30, and that is a very good risk reward, and you can smack on a lot of it. This is a chart of term premia. It stopped updating here on the 6th. We are somewhere around here, but you can see how this could easily be a treble top, and if we start breaking above, what happens? It goes a hell of a long way. So let's have a look in the past where this has been. You can see that if we are now in a position where we break out, we will easily go to this kind of level, which is 100. Okay, 100 to 125 would be term premia, which would give us a very, very good move in 10s 30s. So that is why I want you to be aware of it, and you can do a lot of 10s 30s because the risk is so small, and therefore that is probably my favorite trade on a Fed that the market thinks is being irresponsible. You could easily go to 100 basis points from where we are, 50 basis points, and that would correspond to a move of at least 30 basis points in the 10s 30s. So that's very interesting to look at. And I don't think the first market reaction is going to be to make 10s 30s move. And therefore you'll have time to do this trade. Europe was surprisingly disappointed, but the yield curve basically continued to steepen. And that is really the story in Europe, that we all expect further cuts to come, the economy to remain as weak as it has been, and therefore the Schatz is really not going anywhere. If you see it at these levels, 218, it's a great buy against everything else. And as you can see, we have the 2s 10s. It's continuing to bleed and will continue to bleed. Eventually it will go down again to these kind of levels, remain in a range, and then with time break down. But I think it needs a lot of time first. What is interesting is the differential at the longer end, and if we go here, we have 2s 2s which have remained roughly in the same range. But what is beginning to look interesting is 2 10s, which are now approaching the 220 level. Beyond 220, you get this kind of move. You know, it gets to be quite strong towards 259, 260, and that's a further 40 basis points. And I would not be surprised if that were to happen if the Fed were irresponsible and the longer end in the US just went berserk and started absolutely spiking. Don't be surprised if that happens in December, because as I've told you, I think if the market and the big players think that the Fed is being irresponsible, they will flee to tips, they will flee to gold, and they will flee to equities, because that is all that you can buy. Nominal bonds, just forget it. On a dovish cut, the dollar will get sold. I'm pretty positive of that. On a hawkish cut or a no cut, you just do not want to be short of dollars. I think the dollar will go to at least 109.30 on a hawkish cut or a no cut, and still the dollar is trading very nicely within these technical levels. Around the 105.50 area is where your big support is. There is absolutely no way that it goes through this 105.50 area if the Fed does a hawkish cut. Absolutely no way. It'll just start ramping towards 109 and probably, try over time to take out even this 114 level. The only way that the market can compensate between the differences in monetary policy that will evolve if the Fed gives any hint that they're done for now, that this is it, so even if they cut, there are no more cuts to be expected anytime soon until the data changes. The only way is through the FX mechanism. And then you're looking at Euro USD, which really has to come down by at least percentage points. You're looking for just above parity and then these levels here around the 96.70 area, because that is all the market can do. Let's face it, Europe will continue cutting. If the Fed says we are done for now, boys, it's going to be a buy dollars fest. They're just going, and in December, who is going to stand in their way? This is the way that they tighten monetary policy, that the Fed is, leaving quite easy. And that is especially if they start losing the long end. If the yield curve steepens and you don't have any more cuts priced in, then all you can do is buy dollars. That is the only thing that makes sense. Gold did nothing on the week, but it's quite noticeable to me that what it's doing is actually breaking out in terms of nominal bonds. Nominal bonds had a nightmare over the course of last week, and gold did nothing. Gold went up with bonds, and now it's still way higher than it was when bonds were at these levels at the highs. So to me, it's breaking out. It's showing relative strength to bonds. We can have a look at that in a moment, but I think it's very, very unlikely that gold now absolutely collapses. The only way that gold would collapse is a Fed which is extremely hawkish. So now this is GLD over TLT, and as you can see, it's still bull flagging rather, and it's ready to break out. So if the Fed is in any way dovish or it's not hawkish enough, this breaks out and goes higher. And even gold tip, although it's much less pronounced than gold TLT, is really doing nothing but consolidating and waiting. So this tells me that the market is ready to buy gold if the Fed is ineffective. If the Fed looks like they will tolerate higher inflation and they are still, just we'll cut rates and we won't be hawkish and we'll say that we'll keep on cutting them because we think we are restrictive, because some silly model tells us that R star is somewhere. Those excuses just aren't going to hold anymore. If after these inflation numbers and unemployment numbers, they are still as dovish as they were at the last FOMC, I think all this breaks out. And I think people buy TIP, they buy gold, and they buy equities. So last week, very little happened in SPX, but that is not because very little happened in the stock market, but that because it was just rotation, and SPX as a result did not very much. But I just want you to know where the support levels are. The first one is 6,001 basically, and then we have nothing until 58.64 and gap fill all the way down to whatever that is, 57.82. So if it's bad news, people will buy equities, but the first reaction is going to be down. So I would want to be buying calls when it gets down here, 58.64, because I think you're going to have a big down candle if the market is disappointed by the Fed action. But it's a buy. If the best outcome for this economy longer term is for the Fed to remain vigilant, get inflation down to 2%, get GDP growth to be not too excessive, so they don't have to have a stop-start cycle where they actually have to hike later on, but that you have a nice steady growth path ahead with low inflation. That is the best thing for longer term for the stock market. So if stocks come down, I'm going to be a buyer of 3-month calls down here, because I think that if it's a hawkish cut or a no cut, that is the best long-term outcome for the stock market. The first reaction might be silly and down, but at these levels or inside to the gap fill area, you really be wanting to buy. And I don't care what the rotation does, and I don't care what the orthodoxy is. I think that if the first reaction is down on a no cut or a hawkish cut, it's the wrong reaction. And people will soon realize it, and you want to be long of calls. The internals of the stock market last week were actually very bad, but they were masked by XLY because A, consumers are on fire, but B, it's got such a large allocation to Tesla. XLK, which wouldn't go down, and the Qs, which just kept on going up. So XLK, QQQ, and the difference between the allocation there to Nvidia and less here, and XLY was what made the stock market go up, or rather not go down. Apologies. But have a look at XLP, have a look at XLV. XLF is still holding in pretty well. XLI came down like 2 weeks in a row, just down closes all the time, and it's just about to fill the gap on the election night. So that tells me that sooner or later SPY is going to do it too, and that is why I want to be prepared to buy the calls when it gets there. What's this saying to me? It's saying that higher bond yields are having an effect on the sectors of the market that they should, and it makes perfect sense. And that should continue if it's a normal cut, i.e. not a hawkish cut. You'll get the bond market going up in yield, and you'll get all these sectors continue to be sold. XLF is not really going to hate it because you keep on getting a steeper yield curve, and the steeper the yield curve, the better for XLF. So it's really much of a muchness. People don't like XLV, people don't like XLI, people don't like XLE, and that's it. They are preparing themselves for what the bond market might do, and I think we all know that the real danger here is that he loses the long end and the confidence of the long end of the bond market, in which case all the other equity market that you want to be prepared to buy calls on a move, let's say down to here, 48.50-ish, 48.80, 48.50, is this one, because then this is of course the stocks, because I think that if the dollar starts going up, it's going to really make the monetary policy in Europe even more effective and their exports cheaper. And I think that this is the one market which over the course of the next few weeks could really start exploding to the upside if the dollar starts going up big time. So this is the market that I would not sell, and if there's any dip towards 48.80, 48.50, I would buy calls. Depending on what the Fed does, I really would not think that these support and resistance levels are going to hold. The Fed is going to slice through them like a knife through butter. But we have our outcomes, and I've written them all down here, and you have the link so you can download the previous SEPs and compare to what the Fed does. It's definitely going to be volatile, but I think we have our plays, and we can just call them as we see them. I still think that if the Fed is being irresponsible, your term premia are going to balloon, and the safest play is the 10s, 30s, which is a pure term premia play. Thank you very much, and I will tweet you on Monday. And by the way, I'm keeping this short because I'm doing it on my mobile, believe it or not, because my internet is down. Thank you, and speak to you tomorrow.